We take travel for granted. Airlines are sophisticated network businesses that combine high fixed costs, long-lived assets, and great operation complexity. Well, the strongest carriers use network design, loyalty economics, revenue management to really generate resilient profitability, but many other airlines remain vulnerable. Their margins can be thin, their capital structures can be fragile, and their exposures to demand and economic cycles and fuel volatility can be really unforgiving. And so inevitably, from time to time, such airlines fail. And when they do, their failure causes ripples to the whole travel value chain, all the way to the stranded passengers. Despite the industry's maturity, this problem persists and imposes significant costs to the travel industry. Does it have to be this way? What tools does the industry have to change the risk and to change the risk landscape for the airline sector and for the sector as a whole? Can the impact of failure be contained? And can the costs associated with this kind of risk be taken out of the industry that really badly needs higher margins? To help me answer these questions, I'm delighted to welcome a stellar cast of experts in this webinar.
My name is Livia Vite. I'm the CEO for Actuary.aero, where we provide payment data intelligence via our AI platforms to create a single source of truth. And basically our aim is to help payment providers manage risk whilst enabling more working capital for merchants. And the flip side is enabling merchants to take the driver's seat of their payment strategy. And so our main focus is on deferred delivery verticals. And of course, travel is the biggest one of those.
Hello, Alex. Thank you for having me here as well. So I'm Damien. I'm the Chief Product and Partnerships Officer at Outpace. Outpace being the payments company within the Amadeus group. And our purpose really at Outpace is to make travel payments smooth and simply paid, as our tagline says. And essentially, we're providing pay and payout solutions for customers all over the travel ecosystem, so primarily airlines, travel sellers and hospitality customers.
Thank you, Alex, for having me. My name is Paul van Olven and I'm an independent travel payment consultant with some 20 years of experience in the industry. And credit risk has always been a topic close to my heart because it's key to making it work, payments end to end, and especially since the pandemic, where I also worked together with Libby and the team on the actuary side to restore the trust in the industry when that was at its low, to create transparency in the travel payment flow so that the exposure, the risk that's at any given moment in place is completely transparent to all parties involved, and therefore that the trust can be in place.
Thank you, Alex, for this opportunity to join the panel. And my name is Frank Martin. I am managing partner of Windward Strategy. We focus on strategy and execution work within the B2B payments industry. So I bring a bit of a B2B payments lens to the challenges and opportunities that we'll discuss today.
Fantastic. I'm sure you'll agree with me. We have really a great cast of characters here to explore this problem. But let's start with an example. And this is a particularly complex and very kind of, in a way, at the large end of the scale. Thankfully, this does not happen that often. But the example I wanted to pick out rather dramatically is the collapse of Thomas Cook. When that happened, intermediaries had to refund customers to, basically to really get their money back or get back home. And those intermediaries were not able to tap into the funds from Thomas Cook simply because the organization was no longer really able to supply them with the money. And the impact was huge. 150,000 customers were impacted. They were abroad when Thomas Cook ceased trading and had to be repatriated. So these are just the people who are stranded. There were 250,000 refund claims that had to be processed by the industry in a very short space of time. The value of those refunds was over £350 million. So again, this was quite a big blow, right across the distribution chain in the industry. And around 1 million customers in the UK lost future bookings with the firm. So this really has kind of impact all over the place, right? Admittedly, a rather large and dramatic example, but it's one of those that individuals, but more than individuals, perhaps the company in the distribution chain will remember for a very long time because it was so disruptive and impactful. So Thomas Cook was a big one, but there are many other examples. And if you just take the last couple of months, Blue Islands, Eastern, Play Airlines, these are airlines that have gone under, have ceased trading. So this isn't something that never happens. This still happens today, albeit thankfully the cases like Thomas Cook are quite rare. And so if I turn first to you, Damien, basically, Outpaced operates within the Amadeus Group, right? The world's largest aggregation of air content and data, and also serves airlines, actually. Tell us about the frequency and the scale of airline failures in recent times and the ability of the industry to see them coming.
So I think you've raised already some examples. And I think if I sort of extrapolate that to give some numbers, we've probably seen over 20 airline failures over the last 3 years alone, so post-COVID. Obviously you mentioned Thomas Cook, that was pre-COVID. Obviously this obviously still continuing for a number of factors, whether it's obviously the macroeconomic situation that we're facing, higher costs faced by airlines. And I think we should call it airline failures because there is an element of, let's say, bankruptcies or going out of service. And you've mentioned some of those examples there. Then you've got some other airlines who partially cease operations and file for Chapter 11 bankruptcy. When you think of Spirit, for example, or or if you think of, for example, Wizz Air in Abu Dhabi, so not the whole airline going down, but obviously cancelling operations at a certain peak. And unfortunately, I wish I could tell you that we have a magic wand of detecting when an airline failure is going to happen. Unfortunately, we don't. We certainly can measure, and I'm sure my fellow panelists will discuss that in more detail. Certainly when it does happen, like you mentioned, Alex, in the Thomas Cook situation, you've already got a lot of bookings that have gone into the system because travel, you tend to book before. For leisure travel, you tend to book way before. On average, I think you're looking between 45 to 60 days in terms of time to fly, depending on I separate leisure versus business. But it's very difficult to determine when it can happen. I think so we can measure it, but determine when it can happen, you really have to look at those macroeconomic situations to really get a gauge of whether it can or cannot happen.
So thank you for that, Damien. So it does really remain a kind of clear and present risk for the industry, right? And it's obviously our topic for today. Frank, if I may turn to you, in the US where you're based and in Europe, customers largely pay for travel using cards. Now, there are many other payment methods, obviously, coming on stream, but cards are a big feature of how consumers pay for travel. And if you think about travel agents accepting cards for these holidays, that then might down the line be affected by these airline failures. Tell us a little bit about the exposure that arises to the travel agents from the inability of a supplier like an airline to deliver the actual service that they have paid for.
Right. Thank you, Alex, for the question. So, of course, any consumer paying for an airline ticket with a credit card will have an expectation that they would have the ability to receive their funds back, under the types of situations that you're referencing. And we should mention that even beyond airline failures, there are a lot of different ways in which airline travel can be disruptive, even beyond the control of the airlines, in cases where these tickets will need to be refunded. I think of an interesting analogy. When you purchase a house, you hire a title company, and maybe you could think of a title company as an analogy to an OTA. The consumer pays the title company, and the title company pays the seller of the home. Imagine a world where that title company couldn't keep track of those two payments together and be able to join them back, particularly if there was an issue, say, with the house that was sold, some damage, or some need of refund back to the buyer. And, that's one of the significant challenges we're talking about today, is where the OTAs don't have the ability to track those payments through from the consumer to themselves and then on to the airlines and join those up.
Thank you. So in the end, the travel agent has to pay the money back one way or another, and not being able to find a way of tapping into those refunds from the supplier obviously creates the exposure. And to this point, Paul, you've mapped the value and data flows within the travel ecosystem, actually across a whole range of travel services, including airlines. Can I ask you to kind of elaborate how these risks flow through the ecosystem from airline failure and downstream into the distribution chain? And perhaps also include in that how they might also impact payments providers along the way. Who gets hit?
Yeah, that's the key question here. I think it's good to start with maybe elaborate a little bit on the four-party model in for Visa and MasterCard, for instance, where the card issuer is responsible for the end-to-end payment of the card holder. The acquirer, the merchant acquirer, is responsible for returning the funds if the service is not delivered. And that's a key aspect to it. And the second part of that is that in a travel agency setup, you basically have two models. You can be an agency model where you basically take the consumer card and pass it through your system onwards to the supplier, mostly in this case the airline, for them to process the transaction. In that particular situation, if the airline goes bankrupt, now the travel agent says, well, sorry, I did not get any money. Don't look at me, right? But if, and more, also in the US, by the way, travel agencies choose to become the merchant of record and to basically take a single pay-in for, could be a flight ticket, could be a hotel, could be a transfer from the airport to the city, put on some margin for themselves. And then in the background, they, in a second step, decoupled from the first, they pay out the suppliers in multiple ways. Could be with the use of a corporate card or a virtual card, could be through the IATA clearing system, but also be an account-to-account transfer. And depending on how they have paid the supplier, if that supplier then stops operating, they might have some protection in place that will help them basically to fund that refund, because they will be requested to make that refund if they are the merchant of record. And they will then proactively refund, and they will then try to receive the money back from the supplier, or the payment intermediary in the middle, the acquirer, for instance, or the payment provider. And that's where typically the challenge starts, because if that protection is in place for the acquirer, then they also need to make sure that they are protected against the potential losses if a bankruptcy happens, right?
So it sounds like there is contagion, right? So the travel agent can't get their money back, and if the travel agents themselves cannot stay liquid, then it's onto the card acquirer that has to shell out the funds, in which case the contagion goes downstream to the payment provider. And maybe that's what makes this so evidently the industry is so risky, perhaps, to participants in the value chain. And I think this is a really good moment to bring you in, Livia. Your firm tracks data, and particularly on travel-related transactions, and the liability that arises from these transactions, as you know, has been explained here by Frank and Paul. And tell us about how you map these activities and how you kind of estimate the exposure that arises from time to time.
Yeah, thanks, Alex. So I think these, let's say, we were born out, as Paul mentioned earlier, we were born out of COVID, if you want, because I think it's more than just failures. There are a lot of changes to bookings that come out. So we're very familiar with the challenges that come for acquirers and airlines themselves and travel intermediaries in trying to measure or calculate the actual exposure that is arising out from the non-delivery of a service when it comes to travel. I think when you manage risk in verticals that have these really long lead times, so what people call either deferred delivery or forward delivery risk, as Paul said, there are many parties that are impacted, right? And when this happens, it is from all the way from the impact goes all the way down to the traveler, all the way through the chain. If there is a travel intermediary involved, the travel intermediary. If there is a card payment, then their acquirer. Then if it's the merchant model, you have the supplier and then their acquirer if another credit card is used. So it's really important when we're looking at how we are going to focus on the risk that we get all of the data from all of these pieces of the puzzle and that it's possible to link it, right? So it's really important not just to look at one part of that chain. It's really an end-to-end view. And they need to understand how to calculate that outstanding chargeback liability. So it's not as simple as perhaps a normal goods and service where, the delivery of the service or the good is quite close to the time of purchase. Here, you really need to understand, has there been delivery of the service? And if acquirers, for example, of either the travel intermediary or the acquirer of the supplier does not have that visibility, then they also need to be prepared to assume that their chargeback liability could extend up to 540 days after the initial booking date. which is quite a specific rule that the two main schemes, Visa and MasterCard, have in place, and which really came under pressure and was tested quite significantly during COVID. So this continues to be something that is there. We see, we've had a couple of airlines on our platform that did go bankrupt, and we were able to help them because we can actually see whether some of those flights were flown, because sometimes a lot of the losses that come out of this is a lack of data to understand, what's happened in between the booking and the airline failure itself.
Thank you. Look, data clearly is a huge asset in trying to find, purchase on this problem, and we'll come back to that in a moment. But I think what we've really established here is that when airlines fail, the distribution network and the payment providers that service, they're all exposed to these potential financial losses. I'd like to focus on the intermediary for a moment, on the travel agents as one of those intermediaries. Why does the kind of current payments architecture, we had to kind of really drill down into this, why does it have to bear so much risk? So they seem to be caught out in the middle here, right? The intermediary that is ultimately making the distribution happen, they're being squeezed by the fact that they don't have necessarily access to the money to be able to refund. At the same time, an obligation to refund, and never mind the data to know who to refund and for what purpose. Maybe Frank, let me turn to you. How, if you had to sort of perhaps play to us the perspective of an acquirer dealing with a really large travel portfolio, a portfolio of travel agents, why do travel agents carry this liability ultimately? And how would an acquirer look at serving them and in terms of the risk involved?
Yeah. If you think about the payment processes, you had mentioned, Alex, the pay-ins and payouts, at so many travel agencies, those processes were developed before the advent of embedded finance. So while those travel agencies were probably looking for the most efficient way to accept cards from their customers and to pay the airlines, sometimes the most efficient process before embedded finance did not carry some of these guarantees and so forth that Livia is describing. And merchant acquirers, to focus just on getting the transaction for those OTAs, should think more about how are those OTAs actually protecting themselves and their clients, and taking advantage of some of those payment guarantees that Paul was mentioning. When the data is well connected through, for instance, a virtual card process, where the OTA accepts a consumer credit card for the travel or business card, and then uses a virtual card to pay the airline, and has all that data well organized and together, as Livy has mentioned, and is making sure that virtual card transaction is qualifying for that chargeback guarantee, as we've discussed on the call. That's a much more elegant way for a online travel agency to run the business in today's embedded finance. It is feasible, and perhaps even gives them a chance to go back to their acquirers and discuss their merchant acceptance fees or reserve accounts that maybe traditionally were required and may not need to be at levels so high now in the future.
Thank you. There's a lot of it there, right? That making sure that the travel agent is tracking the payments, but also is then using virtual cards, is to be able to tap into the chargeback guarantee. Perhaps I'm going to turn back to you, Livia, on this, which is how in practice, how can acquirers track these payments, and how can travel agents track these payments? And when the moment of truth comes, what typically could go wrong, or can be planned for to go right, to be able to have a successful winding back of receiving the money from the bank of the airline, so to speak, to be able to stay whole?
Yeah, I think if we take a step back, so again, looking at it from an end-to-end point of view. So the first step would be, I would start from the supplier's acquirer. And from that acquirer's perspective, their first step is to understand the initial booking and payment data, right? So this is what let's say up until recently, this is what most acquirers are doing. They would understand what's the initial payment, what's the initial booking data, including when is the first departure date. But this only still gives you quite a limited view, because even when it's the acquirer, the end supplier, and and you actually get this departure date, there can still be this variance, as we've seen, of 10 to 25% on what the actual exposure is meant to be. So ideally, what acquirers need to be doing is looking to understand how their exposure is evolving for each booking between the time that the booking and payment is made and the actual time of travel. And in particular, if we're talking about airlines, when has it been flown? Because there is actual data on this, right? We know, we can see exactly when a customer has boarded, instead of working off, average book to fly estimates and averages. Then this is, for me, the only way they can really ensure that they're not, let's say, being under collateralized, or even more importantly, over collateralizing at the supplier level first, because of course this has a negative impact on working capital in an already low margin industry. Then if you move to the second part of this chain, which is the travel intermediary, this, I think you mentioned, Alex, that this becomes a little bit of a black box, because they're not the end deliverer of the service, right? They just sell this service and they rely on the supplier to deliver this service. So the acquirer then needs to have an even better understanding of whom they're working with, because it's much harder to track that usage. But what they do need to understand are things like market mix, segment mix. Are they selling just flights, hotels, cruise? What mix of that are they doing? What type of suppliers, and the mix, the diversity of the suppliers in there. And probably most importantly, when are the suppliers being made? Because I've seen in my career, quite a lot of agency failures where the supplier hasn't been paid, but also how they're paying suppliers. So to Frank's point, a travel intermediary can find themselves in the position of a customer where if they've used cash, they just need to wait in the line of creditors for a cash refund. But if they're paid with a means that actually protects themselves, it can make them more financially resilient. And acquirers should recognize that's the case.
And I think
bottom line is,
I think that joined upness is exactly what
right.
is missing. And the data is a clearly critical part of that, but also then the tools for getting the money back. And this is maybe where I want to turn to next. So I think the payments industry is highly aware of the exposure, and clearly they're developing different strategies for managing this risk, and including using the data tools that you've been describing, Lydia. Sometimes, the industry is not necessarily the most optimized at managing this risk. So many acquirers would cap their exposure to travel volumes. In a way, that's a business limiting approach, right? By necessity, they might retain funds or hold collateral. Again, that imposes working capital costs on the industry. And so these kind of options, or they might even insure against the risk. I think quite a lot of acquirers that are exposed to the industry insure against this risk, which again introduces new costs into the mix. But I would like to really focus on something you said earlier, Olivia, which is those travel agents that use, for example, virtual cards and have the guarantee, that Frank was talking about, the charge by guarantee. They are in a really good place to basically, be able to get access to some sort of recourse as intermediaries. And Damien, I'm going to turn to you. So many travel agents use virtual cards today to pay airlines, and of course, Outpace provide access to a whole range of virtual cards solutions to travel agents of all sizes. How, unpack how this helps actually travel agents reduce their exposure to airline failure. In practice, how important a reason is this protection that virtual cards provide a reason to use virtual cards in the first place for the industry?
So, all right, I think that's one of the biggest value drivers of using a credit card. Obviously, virtual card is a form of credit card, which inherently the schemes have devised insurance policies. And we're all almost in the middle of Black Friday. And imagine I'm buying a TV on Amazon and that TV doesn't show up. And Amazon refuses a refund. I always have the recourse to call up my bank and say, hey, the goods and service that I've purchased haven't been delivered, as many of you have pointed out already, and therefore you have this insurance which we call chargebacks, which we've been mentioning times already, as part and buttoned into to the cards or to your credit card, which it's a value, it's a feature of the credit cards And you're right, Alex, in the OTA space or in the travel intermediary space, virtual cards, because of an automation, are used for many reasons. There's an automation benefit, there's an efficiency benefit, and so you can move away from manual processes to automate how you make payments to suppliers. But obviously, having this insurance policy, which we call chargeback protection, is a key element of that. And we've seen, ultimately, if you put yourself in a travel intermediary shoes, in the event there is a supplier default / bankruptcy, you're essentially shifting that risk from the travel intermediary to the end supplier. No? So because therefore, if I'm paying the airline or the hotel with a bank transfer, like you said earlier, you're waiting in line from the creditors if they go bankrupt to get your money back. Whereas if you pay with a credit card or a virtual card in this case, essentially you can enact through the schemes to the airline's acquirer to try and get your money back. So you do have this fail-safe or chargeback protection, which essentially in practice shifts that liability onto the supplier of the service rather than the intermediary who sold the service to the end traveler.
Very good. So we're starting to see some tools, not just the data, but also tools to get that to really kind of manage that risk down. And Paul, specifically in this context, in the context of payment flows and payment-related risk for travel intermediaries, there seems to be both the exposure to airline failure to basically the claims that consumers will make, but also, as Damien was talking about, the actual mitigation of exposure through the use of virtual cards. Do these sort of automatically cancel each other out?
I think it's good to maybe take it one step back and also look at it a bit more holistically, because in the end, it's the end-to-end process, as Lydia already said, right? So if the travel intermediary uses a virtual card, then it basically passes the buck to the airline, the acquirer of the airline, right? So, and a key element to this whole discussion is, the acceptance of any form of B2B payment that's selected by the travel agency. And I think we've seen now a trend where more and more, if it's with NDC, where you have bilateral agreements between the travel agency and an airline, that the form of payment also needs to become part of that discussion. And it needs to be a value exchange. It needs to be a tool that, yes, provides protection to the travel agency, but not necessarily completely at the cost of the airline. Just say, well, you want to protect yourself? No, we have to pay for it, right? So in the end, you have to find a way where both sides feel comfortable, feel secure, and that it enables basically, growing collaboration and growing sales, right? At acceptable costs. I think that's always key to it, because if you look too much on one side, then it might not work end to end. So basically, both sides need to step into each other's shoes. Say, okay, how can we work together in such a way that we find a good balance? Yes, if the travel agency acts as merchant of record, they can enable sales in a way markets for the airline. They can accept local forms of payment that the airline is not able or willing to implement. So there's a lot of value that's created by the travel agency on behalf of the airline, and there's a price tag to it. But that price tag needs to also be in an acceptable level so that both sides can sign off on it, right? So, and yes. To give another viewpoint on this, if a travel agency uses a virtual card, then also the airline is basically at the time of booking guaranteed that they'll receive the money. With BSP Cash, IATA BSP Cash, there's a billing period, and that could be a week, could be 2 weeks, maybe even longer in some countries, where if the travel agency goes out of business, then the airline might end up not being paid, but still has to honor, based on IATA resolutions, the ticket that they have issued, for the customer. So there are quite a lot of elements that play a role in there. But using virtual cards from an automation perspective, from a protection perspective, definitely has a lot of advantages. But again, this takes two to tango, right? So both the supplier and the seller need to agree on that, and have a robust approach to it, and then I think it can work out very well.
Thank you for that. That's really, I think it's a really good balanced view. It does sound, if I had to kind of summarize, if you like, what we've heard from you, Paul, and what we've heard from Damien, is that yes, virtual cards come with their own costs, and perhaps the wrong form of virtual cards or the wrong form of economics of virtual cards might be unpalatable, particularly to the airlines. But there is a landing zone there, it seems, that the airline industry could be better off because they are guaranteed the cash flow. The travel agent could be in a better place because they are guaranteed, they can tap into the automation, but also the protection that gives them. So it feels like there's almost like a design. It's not necessary. It's not necessary that all cards are optimal for all parties, but perhaps by finding the right type of virtual cards deployed in the right way, then actually it really could reduce the risk and provide benefits to the industry. And perhaps that's one of the reasons why virtual cards have been so successful, in terms of the adoption in this sector. I think from what we've heard here, and I'm trying to assemble together these kind of what I'm seeing as kind of three elements. And we're excited about this at Weaver because our whole job is to assemble different types of financial services, different types of financial instruments together into solutions that solve real problems. And we're excited by this because we can see the world of acquiring come into the mix with the world of virtual card issuance, also with the world of rich data. And when you put these three together, I think you have the makings of a solution that gives us a handle on managing the risk. There seems to be enough of the pieces that all the parties are paying some economic price, but also getting some economic benefit of participating in this data-rich, guarantee-rich ecosystem for moving payments across the travel value chain. So I'm very much thinking now from a systems point of view, rather than the discrete parts. And I'd like to explore this, the final part of our webinar, this sort of mindset around a solution, a system that is composed of these different parts. And I'm going to come back to you, Livia, on this one. As an aggregator of travel transaction data, in terms of your of the role of data in this kind of solution, what would you be asking to make yourself comfortable that a travel agent or an acquirer's exposure is indeed covered, like in the moment of truth when it comes to filing those chargebacks? What would you like to see there being available so that there's a high guarantee or a high degree of confidence that the risk is actually covered?
Yeah. So I think there's two key things in my mind. So source data is really important. So we always say data out is only as good as the data in, so garbage in, garbage out. So here it's quite important because everyone has this data in the industry, not everyone, but there's a lot of this data sitting around in the industry. Is it good data? I think a lot of people that's the first thing, is you need to check the quality of the data, and you need to know how to put that data together to tell the right story, particularly on all those events that happen post-booking that I mentioned earlier. And again, I know it sounds repetitive, but it's really not enough only to look at it from the travel agent acquirer perspective, but also from the supplier acquirer perspective, so that we take into account the end-to-end from traveler to supplier, so that we really take into all of those pieces of data. The second piece is visibility. Right. So I think, whether we're talking about the supplier with their acquirer, the travel intermediary and the acquirer, and we don't want to go into this in too much detail, but between some of these guarantee funds and the acquirers, when you're not looking at a single source of truth, or that not everybody is looking at the same way of looking at the data, what we tend to find is situations of over-collateralization, double bonding, whatever you want to call it. So for me, the aim of these two things, having the right data and knowing how to treat it, and having mutual visibility, is the aim is to optimize how we protect the ecosystem or this industry against the losses that arise from airline failure, so that we're not, people are always going to game the system. So if we have that data, then we're able to actually challenge those and fight those. And as long as we don't do that, then working capital is going to be impacted. And it actually starts the schemes to their acquirers, to their merchants, whether it's a supplier or the travel intermediary, and then often those costs are passed on to the consumer. So and then because it's low margin, it becomes a self-fulfilling prophecy, because lack of working capital means that, how are they going to continue to operate their businesses and be financially resilient?
I think you make a really compelling case for the economic value of a single source of truth here. The fact that every party in what is a complex value chain can rely on the fact that there is a booking and that there is a lead passenger, and there are dates when flights have happened, and the flights have happened or have not happened, actually really facilitates the processing of those claims, and therefore gives that confidence that the system of guarantees can be relied on at the moment of truth. So definitely, I see a very big role for that kind of data in the solution we're talking about. I'm going to move to the other bits now, the issuing and acquiring. And Damien, I'm going to turn back to you. Outpace is involved in both acquiring and issuing, actually. And of course, you're sitting on the world's deepest pool of air travel content. Has this sort of coordination of back-to-back acquiring and issuing been an area of exploration for Outpace? And what insights would you share about the design of the kind of solutions we're discussing here? Where are the gotchas?
And the gotchas. Yeah, look, I think, certainly I think there's not just Outpace has been thinking about this, of course, but I think you've seen there's many different players certainly the travel fintech space who are now providing sort of that connected payout offering. And I think to Livia's point, actually, the key is having the confidence, is visibility in the data so that one side can operate knowing what's coming on the other side. So to give you a very practical example, just a very specific example around cash flow. So we all know when for an airline payment, as opposed to a hotel payment, for an airline payment, you pay when you book. And you're taking payment at the same time you're taking the customer's payment. So therefore, as a travel intermediary, in the same second or 2 seconds, I'm not only taking the payment from my traveler, and that will take 1 or 2 days for those funds to arrive in my bank account as a merchant, but I'm having to pay at that same instant the airline, if I'm acting as merchant of record, as was mentioned earlier. So therefore, we've got a cash flow inconsistency. So one of the things that most players have been looking at is say, hey, by connecting what money I know is coming in from my traveler who's purchasing that flight, I can use that to fund or I give confidence to the issuing side of the solution that collateral is on its way in the next day or two, whatever the agreement is with the acquirer, the agency, to have confidence to then forward and pay the end supplier with a secondary payment, for example, like a virtual card. So certainly connecting both together. If you didn't have both connected together, the issuer has no visibility on who's initiating that transaction. You have a cash flow issue. So by connecting both together, you sort of kill 2 birds with 1 stone in that sense. Obviously, the gotchas there is really around the data. So how the data flows certainly is when you're looking at putting these 2 elements together, you need to make sure, and I think Livia mentioned it quite extensively, all the data needs to flow through end to end when you're connecting both pay in and pay out together, and even downstream to the end airline or supplier corridor that Livia mentioned. So the flow of data is key. I think I'll just repeat there what my colleagues have already said.
Fantastic, and I love the way you've described this as a system, right? And you've added the element of working capital in the mix as well, besides the risk, the management of risk exposure. Frank, I'm going to turn to you on the economics of this back-to-back card issuing and acquiring solutions. Would travel agents be worse off, better off, or neutral by adopting such a back-to-back acquiring and issuing solution? Do you think? And how dependent is that on the car scheme economics in US and Europe, for example?
Yeah, I think much better off. So a couple thoughts. As Paul mentioned, for the airlines to consider taking cards, there does need to be balanced economics between the airlines and the OTAs. One of the things we are seeing, Alex, in B2B payments is a product called 100, where a buyer, 100% of their payments or payouts go on cards under different circumstances, depending on the accepting merchant. And it would be really, I think, an amazing opportunity for an OTA if that product were available. So anytime an OTA pays, they only have one process for payouts. It's always by virtual card. And through the flexible interchange rates that are operated or offered through the schemes or networks, as well as a situation where it may need to be a buyer-funded transaction where the buyer's paying the transaction fee, which we are seeing on the B2B side. That does potentially involve some negotiations with airlines around acceptance and understanding those rules. So I appreciate that might be a future world, but the whole goal would be to completely standardize the payout process. And I think it's really important to think about it this way. There might be an isolated transaction in this example where the OTA would be obliged to pay a transaction fee for a virtual card going to an airline. Now, to Livia's point, there still would be the chargeback guarantee, which has value to the OTA. And an OTA may say on that one transaction, we would be better off economically if we didn't pay by card because we don't want to pay the transaction fee. However, thinking about the OTA's business holistically, they would save tons of money by standardizing payouts and having only one process and always having that guarantee in place regardless. So we really think the industry, I think the industry may move in that direction, potentially again on what we've seen on the B2B side and all sorts of flexibility regarding, back to Paul's fundamental point, balancing those economics between a buyer and seller, but trying to have consistent processes in place for all transactions.
Of course, you've given us lots to think about. We are not going to explore the economics in detail in this webinar. Maybe that's the subject, a great subject for another webinar. I'd like to turn on to you, Paul, which is given we're agreeing there seems to be the makings of a solution here to really manage this problem of risk coming downstream from the supplier failure. What's the business incentive for travel platforms that serve travel agents to offer them or to assemble and offer them such a solution, this sort of combined issuing and acquiring and data-rich solution as part of their platform?
Yeah, that's definitely a trend that I see in travel fintech, embedded finance, where the platform actually moves up or down, depends on how you look at it, the chain, and actually takes on the role of money movement as well, working in a kind of a platform or a marketplace model where they are basically either themselves or with a partner in charge of the pay-in, then hold the funds with a licensed party in the middle in a wallet, and then based on business rules actually pay out when and how the individual suppliers. It could be virtual card, could be account to account, could be wall to wall, could even be stablecoin in the future, right? But I think that kind of flexible middleware layer that basically marries the pay in and the payout in a very sophisticated way and is completely in command, and therefore also generates value, not only on the payment side, by the way, but it could also be by pre-financing or with insurance. So then finance more than payments, right? So yeah, I think that's definitely, we see quite a lot of examples. If it's channel managers, if it's PMSs, if it's meta search engines that have moved up the chain and that have basically embraced that part of the business together, again, either themselves or with partners, typically with partners that are licensed, to make that possible. And that's definitely from enriching their business model, growing their value, quite a significant step in the right direction.
Fantastic. I think we've really gone through a very interesting journey here, really starting with the nature of the problem all the way down to a solution. How good is that? It leaves me really to thank all of you for your very kind of unique perspective into different parts of how we arrived in this journey. I would like to invite you perhaps to leave us with one closing thought in terms of, what do you see as the most important next step into getting to a world where all of the elements that we've been talking about are actually put together in practice for the industry. Let me start with you, Livia.
Sure. I mean, I think it's a single source of truth. So collaboration in this industry is always can never go astray, I think. So more collaboration is needed so that we can get all that data together in one place.
Fantastic. Very clear. Damien?
Yeah, I mean, I think the person who answers later on will have it more difficult to say something new, but so thank you for having me after Livia. Look, I was going to say, I think essentially you're spot on. I concur with Livia, which is access to data, and data means, all the things that we've described today, combined with the capabilities. It's the combination of both financial services capabilities I'm referring to, and then how all that integrates into the touch points. So it is really, I'd say, the combination of all three that you should consider when you're looking at this topic holistically.
Great. Frank, I'm going to leave Paul for last to take up Damien's challenge here. But what are your thoughts about a possible next step, or what would be the next practical step here?
Yeah, I think for OTAs to determine what is the most efficient way for them to receive pay-ins and to transmit payouts, and really to seek to standardize all transactions on that process. Very
good. Good counsel there. And Paul, I'll leave it to you to think to say, please perhaps think futuristically as well.
Yeah, two more things to add. I think Lydia mentioned collaboration, industry-wide collaboration. And Lydia and I have been participating in the ECTA events, European Association of Travel Agencies and Tour Operators. And they are key also because it's not only the data, it's not only the systems, it's also the regulatory framework and the overall industry-wide collaboration that play an important role here. I've heard discussions around extending basically the travel package directive to direct sales, right? So that would mean a major difference. The other part is education. My story of my life is to educate my credit risk teams and credit risk stakeholders about the complexities of the travel value chain and the travel intermediaries, the role they play, the aggregators, the everyone who plays, tour operator, etc. So I think, yes, you can fix the data. Yes, you can fix the systems. But in the end, there is like a chief risk officer that needs to put a signature on the dotted line to prove, no collateral or, a fast payout or to actually believe in the model that you just explained, right? So I think that's a different group of stakeholders with a different DNA, with a different mindset, different agenda. They need to be addressed as well.
Fantastic education and awareness. That's how we get. How we get adoption. Well, it only remains for me to thank all of you for joining me. It's been really genuinely insightful getting these different perspectives. And thank you once again. And I'm sure our audience will be more knowledgeable about this problem and the solution at the end of this webinar.